Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. All right, let's just get right to it. The smartest thing you can do with $100 is to invest all of it, right now, today, not drip feeding it in, the whole thing, all at once. I know. That probably sounds completely reckless, but the data says otherwise. So in this explainer, we're going to dig into why that is, and we're going to look at the mental block that keeps most people on the sidelines forever. First up, let's talk about what the real risk is here. And spoiler alert, it's probably not what you're thinking. Okay, picture this. You've got your $100 ready, but you look at the market, it's up, it's down, it feels kind of chaotic, and this little voice in your head says, whoa, hold on, let's just wait for a dip, wait for things to feel a little safer. That voice, that's not a strategy. It's actually a cognitive trap, and it's what keeps people from ever getting started. So let's do an experiment. Let's just press mute on that gut feeling for a second and see what history actually tells us. The question is really, really simple. You've got a chunk of cash. Are you better off throwing it all in the market today? That's called a lump sum investment. Or are you better off spreading it out? Maybe $20 a week for 5 weeks. That's called cost averaging. What does the data say? Well, the answer really boils down to this one number, 68%. So, Vanguard, one of the biggest investment companies in the world, ran the numbers. They looked at market data all the way from 1976 to 2022, and they found that investing a lump sum all at once beat spreading it out 68% of the time. But check this out. The even bigger story is that any strategy, lump sum or spreading it out, crushed just leaving your money in cash nearly 70% of the time. And the reason why is, well, it's pretty simple. Over the long haul, the stock market trends upwards. So every single day you decide to wait, you're not just playing it safe. You're actually paying a hidden fee. It's called an opportunity cost, the cost of the growth you missed out on. It's proof that time in the market is just so much more important than timing the market. Okay, so the data's clear. Invest now. But that brings up the next big question, right? The big fear. What if I pick a total loser? I mean, what if you put your whole $100 into one company and that company just implodes? It's a totally fair question, but the good news is you don't actually have to bet it all on one horse. The answer is something called diversification. It's just a fancy word for not putting all your eggs in one basket. You spread your money across tons of different investments. And here's the cool part. In the world of finance, this is literally called the only free lunch, because it's one of the only ways to lower your risk without having to give up on potential returns. Here's why that works. Think of two kinds of risk. Specific risk is the risk that you pick one bad company and it goes to zero. You can pretty much wipe out that risk just by owning hundreds of companies. The market doesn't reward you for taking that kind of gamble. But then there's systematic risk. That's the risk the entire market goes down. You can't diversify that away. And that is the risk the market actually pays you to take. So for you, as a beginner who just wants to invest and not trade all day, the goal is dead simple. Use diversification to get rid of all the dumb risk that you can actually control. So this all makes sense, right? The logic is sound. Invest it all, right now, in a diversified fund. Easy. So why does it feel so unbelievably scary? I mean, if the math is that obvious, why does every bone in our body scream, no, wait? Turns out the answer has nothing to do with spreadsheets and everything to do with our own psychology. The big problem here is a glitch in our brains called loss aversion. Decades of research have shown that the pain of losing, say, $50 feels about twice as bad as the pleasure of gaining $50. We are literally hardwired to hate losing more than we enjoy winning. And that's why investing a lump sum is so terrifying. Your brain isn't calculating the 68% chance that you'll do better in the long run. No, it's totally fixated on the immediate, gut-wrenching feeling of what could happen if the market drops tomorrow. That fear just overrides all the logic and leads to total paralysis. You end up doing nothing. And, we have to be honest here. Think of these returns as long-term probabilities, not promises, especially when you're just getting started. Nothing's guaranteed, but what we're doing is playing the odds based on a whole lot of history. All right, let's put this all together. We've got the historical data, we get the psychology. So what's the one simple, smart thing to do? And here it is. This is the aha moment. For a new investor, the biggest risk isn't investing right before a crash. It's the slow, quiet, guaranteed loss you suffer from the opportunity cost of just not being invested at all. Which means that successful passive investing isn't really about outsmarting Wall Street. It's about outsmarting your own brain. It's about knowing your own biases and having the discipline to choose data over drama. So the game plan is this simple 3-step process. Number 1, acknowledge your bias. That fear you feel is totally normal, but it's not logical. Number 2, trust the probabilities. History's on your side. And number 3, maximize your time in the market. Get in now and let time do the heavy lifting for you.
So there you have it. You know the data, you know the psychology, you know the single smartest way to invest $100. The path forward is pretty clear. So, what's stopping you?